Hello, and welcome to a new podcast series, Source of Truth, sponsored by our friends at Solo. On a fundamental level, this series is about information asymmetry. Now, information asymmetry is the enemy in financial services, and especially in lending. The difference between what the customer knows and what the financial services provider knows is the reason why first-party fraud happens. It's the reason why qualified applicants get declined for loans or approved for loans at rates much higher than they should have to pay. It's the reason why borrowers and human underwriters spend a mind-numbing number of hours locating, aggregating, and verifying information. Now, to be clear, we've made some progress in solving this problem over the last few decades, but a lot of that progress has been siloed and incremental. We've standardized certain data inputs, we've digitized specific steps, we've introduced some automation and alternative data. However, the overall process still looks very similar to how it's always looked. Why is that? And what can be done to reshape that process in a more fundamental way? Those are the questions that we'll be exploring in this series. And I have to tell you, as a dyed-in-the-wool credit reporting and credit scoring nerd, I could not be more excited to dig into them, especially because we have some great guests lined up for this series. The first of those guests, the guest you're about to hear in episode 1, is Georgina Merholm, founder and CEO of Solo. Georgina is a data scientist by training, and as you'll hear in our discussion, she has a very unique way of thinking about how we collect and use data in financial services, and how those processes can and should be improved. And that's exactly what this episode is about. It was a great conversation, and I can't wait for you to listen to it. Now, before we get there, I want to offer one quick disclosure. I've gotten to know Georgina fairly well over the last couple of years, and in fact, I recently became an advisor to Solo. So the conversation you're about to hear will likely sound a lot like a conversation between two friends who've been talking obsessively about this topic for a while, and that's because that's exactly what it is. However, as with all sponsored content here at Fintech Takes, even though we are working with sponsors to bring a lot of these ideas to life, the thoughts you're about to hear from me are my thoughts on this topic. And I think they're pretty good. So, without further ado, here is episode 1 of Source of Truth. Okay, Georgina, thank you so much for joining me on this first episode.
Thank you for having me.
I am delighted to have you, and I am delighted to be collaborating with Solo on this podcast series. This is going to be a fun series of conversations. You know, it's funny. We got to know each other a while back, and I think we sort of first bonded, if I'm remembering right, on our sort of shared nerdy interest on all things credit reporting, credit scoring, credit decisioning, and just like the infrastructure that goes into managing data and making decisions. So I'm excited to have the opportunity in this episode and in the series to explore a lot of those same ideas that I know you and I are both really passionate about.
Yeah, absolutely. I feel like a lot of our conversations could have been recorded as podcasts. So really excited we get to do this.
I was just going to say, we're going to remedy that problem right now. We're going to start recording our conversations as podcasts. So I think where I'd like to start in this discussion, because there's a whole bunch of different directions we can go, but one of the things that you have said to me in the past that I've always thought was a really good observation, and quite frankly, not something that a lot of folks in fintech acknowledge or think about as much, and I think that's really interesting, is the underappreciated virtues of in-person lending. So obviously, we exist in a primarily digital space these days. Lending has really been eaten from a distribution perspective and a technology perspective and an infrastructure perspective by digital technology. But, you know, I want to start by talking about and kind of jumping in the time machine to a degree and talking about the past and how lending used to work and what some of the things were that we used to do that actually worked really well and were really beneficial that we might have lost touch with a little bit as we've sort of migrated into digital. So to start with, I want to use a specific use case because I think that'll help us kind of unpack this. So let's use small business lending as the example, because that's, I know, an area you and I have talked about in the past. Walk us through, if you will, the lending process and what it looks like for a small business owner historically when they would walk into their local bank branch and ask for capital. What were some of the attributes of that experience that created better outcomes both for that borrower and for the lender?
So I'm going to start with an example I always start with. Georgina's Nail Salon. So Georgina's Nail Salon has multiple locations. It's a franchise, and it's in need of an SBA loan. Let's start there. So I walk into the branch. I'll explain my situation. Most of the time, that relationship manager already knows things about me.
Yep.
Potentially, they've been in touch with me over a different product before, and right then and there, they are counseling me through the process of what we're going to need for this SBA loan. So they're asking me for audited financials. They are asking me to fill out this application, and they're talking me through it and asking the questions. And through that process, there's maybe questions around, well, how much do you make a year? And maybe the answer I give them is based on a cash-based calculation, and so they'll clarify. They'll say, is that to date, is it calculated based on your last few years? And then essentially that just all happens within the first conversation. After that, they will take it into an underwriters department, who will then figure out the eligibility of that application. Through doing so, and through maybe checking with Secretary of State, they will realize there's a secondary business owner. And maybe that business owner has 26% ownership. And so that requires a different application to be submitted in that process. And just there's a lot of, it's nonlinear is what the point we're trying to make here, is that the data collection doesn't necessarily fit into a form or into an API.
So the underwriter discovers something new. Maybe the person that the small business owner at the branch was dealing with before forgot to ask about that, or it just didn't come up. And so then, like, to your point, like, data collection will then go back out to the customer, right? And like, that person at the branch will call the customer, reach back out and say, hey, we also need to collect this information. I'm sorry I interrupt, but like, that's the back and forth you're talking about, right?
Absolutely. We call it resolution at Solo. And so there's a lot of customer resolution that's required at different points of an application. And that's not just on small business, but also even think of credit card lending and needing a personal guarantor if you don't qualify.
Yeah, anything that gets sent to that manual exception where it's like, this is a little different. We need you to get us this piece of information. Mortgage lending is rife with this, right? Like, lots of back and forth. Is it a conforming loan? Is it not a conforming loan? What other pieces of information do we need? And one other thing I want to just double click on for a second before we move past this is, you also talked about examples where it's like, hey, what's the amount of like revenue that you generate? And I might give you an answer because the answer I give you makes sense to me. It's how I think about my revenue as a business. But you, knowing the underwriter who's going to be looking at this loan, or knowing what the SBA requires in order to approve a loan, you might go, actually, no, we need you to give us a different answer to that question. So even like a question that should be pretty obvious might have different answers depending on the context or what the lender needs versus how the borrower thinks about it.
Absolutely. I think there's that problem of the context and the actual data being grouped in an application. Like, if you ask us what our annual revenue is, I could give you 4 different answers depending on where you're looking. I could talk about booked revenue. I could talk about live contracts. I could talk about cash receivables. We could talk about aging receivables. There's so many different answers. And so the back and forth helps remove the context and deconstruct that to understand how to rebuild it in the context of the bank. And there's really 3 areas here that make this a nonlinear process. There's the customer resolution. There's the bank's SOP and context and requirements and how they are collecting data. And then there's the fact that data collection is super decentralized. And so there's information you're getting from the customer. There's information you're getting from third-party sources, such as Secretary of State. And those things all trigger potential resolutions. An example for SBA that's quite common, that we have a bunch of experience with, is around rebuilding the valuation using the NAICS code. So the SBA has specific NAICS code, and there's thresholds on how much you can add multiples. So there's valuation guidelines by the SBA that are based on the
kind
NAICS
of per
code.
industry.
Per industry. Oh, and some of them are based on employment, and some of them are based on revenue. Um, but
Yeah.
once you reach a certain threshold, you don't qualify for SBA. And so that's one of the first
Mm.
things that need to be cross-referenced. And so in that sense as well, there's a holistic, data source orchestration that needs to happen within the context and within the workflow. And it's not standardized because each bank has its own SOPs and every product has its own process. But then in that same light, if you fully focus on it being a relationship-based experience and you actually go through that
Mhm.
entire process, there's the risk of it being not reusable across other products, which
Yeah.
essentially is what we've been solving for.
Got it. Okay. So, all right. So let's then jump forward a little bit because I think you just did a really good job describing, this is the back and forth and the trying to deconstruct context and trying to get the right answers and trying to get to resolution on these types of loans. Sticking with small business as our example, I spend a lot of time researching the sort of evolution of lending for different products and different channels. And in small business, what we know is that this in-person branch-based distribution is dying, right? And it's dying for the same reason that it's sort of dying everywhere because consumers, small business owners, they want convenience. They want to get access to things digitally. If we use small business owners as our specific example, I've always felt like small business owners are ridiculously busy and very impatient people. Like when they need capital, they just need capital right away. And so they're naturally sort of reluctant to spend time walking into the branch, talking, going back and forth, doing all these things. And so digital has started really eating into small business lending volumes. And, you see that in the data, right? A lot of online lenders, a lot of digital lending has really eaten into small business lending from a volume perspective because it speaks to that need for convenience and speed that small business owners prefer. However, the thing I find really interesting is in that same research done by the Treasury Department, the US Department of Commerce, all these different sources, what they consistently find is even though small business owners have shifted from a volume perspective over to digital channels, they're actually not that happy with how digital lending is going, and that the rate of satisfaction that they have in working with digital lenders is actually much lower than the rate of satisfaction they have when they work with in-person branch-based lending. And I'm curious to get your perspective on, A, why you think that is, and B, like, what have we lost as we've shifted in small business and in other product areas from a branch-based in-person process like the one you described to more of a streamlined digital process?
Yeah, it's a great question. And I think there's two things I want to say here. The first thing is not only has satisfaction gone down, but you also actually have a lot more inefficiency now within the financial institutions, and the velocity of
Mm-hmm.
how you underwrite has actually gone down, even though you've added more systems and technology and
Mm.
databases. And so that just, I think to me, speaks to the fact that even though you have more data sources now, on the bank side, you actually that just adds more work because you're having to copy
Sure.
and paste between 50 different tabs, and then the answer you get from one data source requires you to reach out to the customer in a different way. And so and to keep all these systems of record up to date is a huge burden. So you would think
Right.
that when scaling transactions essentially would have helped the banks, but it's not necessarily has improved efficiency.
Mm.
You still have $30 billion a year being spent on manual data collection, even though we have APIs. Things don't fit perfectly into APIs and forms.
Well, and one thing I want to just pause on for a second with that, because I think it's really important, is, and I think this is true in a lot of different lending areas, right? What we've sort of done is we've said, all right, here are the easy ones that we can do in a relatively automated fashion. And different product areas have different levels of automation that are easy to achieve, right? So in credit card is very highly automated. A lot goes through those automated processes. There are exceptions, as you were saying before, where you need to get a guarantor, you need to track down a second source of income or whatever. But a lot of stuff is automated in credit card. Small business lending, by contrast, is another example where there are some pockets of small business lending where we've sort of driven a great deal of automation, right? So you see, for example, like Square's embedded merchant cash advance product or whatever, like you see areas where it is highly efficient, but there's a whole bunch of stuff that small business owners need, different types of loans, different exceptions or whatever, that don't fit in those boxes, right? So what you're saying, I think, is every one of those product areas, there are these sort of boxes where we can stuff everything in and it can be fairly automated and fairly straightforward from a processing perspective and efficient. But then a whole bunch of stuff that doesn't fit in those boxes where it is still as inefficient or maybe even more inefficient than it used to be, which is crazy when you're moving from an in-person channel to a digital channel. That's not supposed to happen.
Absolutely. I think one of the reasons that satisfaction has gone down as well is that people, for products that we just mentioned, are harder to underwrite for. It doesn't fit in a form. And so if you don't fit in a form and you need to speak to someone and go back and forth and even ask clarifying questions on, well, I don't have audited financials right now. Could I give you estimates? Or can you help me rebuild the financials, which a lot of actually in-person SBA lenders and small business lenders will do if necessary. It's less of a back and forth when it needs to be. But then also you also have to restart the process from zero. So this is a really interesting thing that we've come across of, like, in the past with relationship banking, you did not need to reintroduce yourself to the bank every time you needed something different. There was a memory of you at the bank. And so I didn't have to re-explain everything. Versus today, because the infrastructure that we've built can scale transactions, it also is built not to be reusable, even within one institution. And so every application starts from zero. And there can be a lot of frustration there. Imagine that within one institution, but then across the entire industry. There's a lot of that's technical architecture that was not built to scale relationships in the past. There's a lot of that in how it's stored, which is also technical. There's an economic incentive aspect to that as well. But then there's also a governance aspect. So it's quite a big, the core issue that I think we've solved as a company is collecting data in a way that can be reshared, both across institutions to enable multiple products and really being able to, what that enables downstream for the customer. When we talk about customer satisfaction is, I go to a bank and maybe I don't qualify for that thing I applied for. Instead of them resending me to a different department with a different link and I have to start all over, they can just port my data over and be able to run the same process, maybe even on 10 different products, and counsel me through what my options are, which is what we got with relationship banking as a result of having memory of the consumer or the small business by the institution. And based on that knowledge, so you had the knowledge of the relationship banker of all the products that exist and all the SOPs, and then deep knowledge of the person. And you would be able to counsel them and say, I don't think you qualify for SBA because actually the business is too big, but we have this commercial offering. Or maybe for a personal loan, it's the context, and so you can also in your mind match them to the right product. Versus the way it's done today, with it being a linear process, there's a lot of burden on the customer, there's a lot of burden on the bank to switch back and forth, and you have to restart the process all over again. And so as a result of that, you're not looking at the customer and being customer centric. You're very product centric in how you do things, and it makes it quite frustrating on both the customer and the bank.
Yeah, no, I think that's exactly right. And just to add sort of a layer of nuance to that, I mean, it's funny, right? We sort of are like, hey, small business owner, you now have a huge universe of possible loan options that you could go get. Go have fun out there, right? And so we sort of like present it as like, wow, digital lending has created all this choice and all this competition. And it has, which is good. But the problem, as you're saying, about moving away from this relationship-based approach is we've put all the work onto the end customer to go, you have to go find the right option. And if you apply and you don't fit for whatever reason and it's not perfect, there's nothing you can do with that one little option that you applied for. Now you have to go over here. And maybe it's a different division within the same lender that you're trying to work with, but there's no memory and you have to start over. Just here's a new digital application you have to fill out. Here's all the same paperwork we have to bring. Oh, we want this in a slightly different way than the other person wanted it, so we have to recollect it in this way. There's no memory, you have to start over. And then, of course, certainly if you're switching from one institution to another, same thing. There's no memory. There's nothing that follows around. And so this idea, I think that, digital lending has unlocked a better experience for borrowers. It's not untrue, right? Because it is convenient to be able to apply without having to go to a branch. It is, faster if everything goes exactly the way that you want and you can get funding efficiently, which small business owners in particular really want. And it can be more competitive because it sort of levels the playing field and you're not just getting a loan from the one bank that's in your community that has a branch there. You can get more loans from different places. But I think it's really deeply naive to assume that just because those things are true, that everything is fixed and everything is glorious and it works perfectly. Because as you're saying, if you have to navigate between different products at one institution, or you have to navigate between different institutions, and there's any level of back and forth or context setting that's required, you're really missing that old style of relationship lending that you used to have access to, right?
Exactly.
So the other thing I wanted to talk about is standardization, which is something that I know you spend a lot of time thinking about. To a degree, and I want to sort of get into this idea that, if you look at small business lending as an example, small businesses are all very, very different from each other, right? And that's why I think small business lending is such a particularly useful example, because it kind of illustrates this very dramatically. HVAC installers are very different from pizzeria owners, who are very different from tutors, who are very different from management consultants, right? Like they're all extremely different, very different from Georgina's nail salon. And yet, a lot of the infrastructure that we have in place for lending is really built on the idea of standardization, both in the consumer and commercial side of lending. We've really sort of honed in on this idea over the last, 30, 40 years of standardization. And before we talk about the problems with standardization, I think we should also talk about the virtues of it and why credit bureaus and credit scores, like why are they standardized? What benefits does that create for lenders and for consumers? Let's start there before we get to the problems with it.
Yeah. So huge benefits around being able to reuse a standardized database, of course. Having standardized clean inputs is super crucial. Having standardized outputs, on the other hand, is where the problem is. I think if you build your entire lending stack around standardized input, that standardized input better be conclusive. But the reality is It's not. You're using multiple different data sources. They're coming from different places. One of the bureaus, just one input. It's great that it's standardized, but it's one input.
And to pause on that point real quick, because I just want to make sure people who are listening understand, that's where like credit bureaus started, right? Was like, of all of the universe of data that we could get, that we could help lenders get access to in an efficient, standardized way, loan repayment data generated by bank systems and collected and organized by us in a standardized format. You have to apply sort of a historical lens to it. Like in the 1970s and 1980s, that was the thing we could digitize and capture. And I think it's really important to pause on this because, to your point, the credit bureaus in a non-digital capacity, so if you go back even further to the 1950s or the 1940s, they actually used to have a lot more information in them, right? Like they used to be more of almost a qualitative overview of borrowers, right? They had repayment information, but they also had all kinds of other, and not always nice, like derogatory information, and right, like they had a wide range of really interesting types of data. But the problem was that you couldn't standardize that in a machine readable format, right? You couldn't like standardize the input and the collection of that data. And to the extent that you could, it didn't create consistent outputs that you could build decisioning processes off of. And so what we ended up doing, and I just want to put this historical point in before you keep going, I apologize for interrupting, is we standardized on a very narrow set of data because that's what we could do at the time, right? And so this episode is brought to you by Solo. If your team is still rekeying the same customer info across 5 systems, stop. Solo is a bureau built as an engine and scaled as a network, collecting, resolving, and sharing customer data across silos in real time. No more scavenger hunts, no more redundant asks. Instead, expect decision-ready data where and when you need it. Learn more at solo.one. That's solo.one. That kind of put us in the position we are now, where when you ask, like, well, why is it the data that's in the credit bureau, the data that's in the credit bureau? It's because that was the thing that was easy to do in 1978 or whenever.
Absolutely. I think as a company, we are very pro standardized inputs as a Absolutely. General premise. So Solo actually standardizes everything that comes from not just the bureau and the open banking sources and the first party data that's reported in an application and something that came in through an email one time. We definitely standardize the data that comes in. So standardization is really, really important for data to be reusable. There's there's reusability because of the standardization across all of the products, but there's also the fact that we need to know how it was collected, which is something that the bureaus and just any other aggregator that exists in the space was never involved in collecting the data. And so that's where the my issue with kind of how things operate today stems from. On the outputs, though, is where I have a real problem with standardization. And the reason, let's go there. The real reason is you maybe can standardize outputs on fraud. It's very yes, no. Like, yes, this person is capable of committing fraud or likely to commit fraud. No, they're not. And so if you create a fraud score, I am very pro standardizing as much as we can if it makes sense. What I think we have an issue with is we've tried to standardize the assessment and not the inputs. And so you can't standardize assessments. If you could, that would mean that someone with 710 would qualify for every product at every institution because that score means very good. And someone with a 450 would never qualify anywhere, which to some extent is true as an approximation. But there is so much more that goes into the decision. Let's look at the economics around scoring today. The banks at most pay $3 on a score versus they spend hundreds and thousands of dollars processing what everyone else is calling alternative data. It's not alternative data, it's application data, and it's the resolution of information that is relevant to a specific event. And so you in the standardization around inputs is great. We do standardize inputs. We should be able to standardize inputs regardless of how they come in. But to standardize the assessment is quite it's just not realistic to how things operate today. It's not even an opinion. It's just based on how things operate today of how you derive a decision. It's not based on one standardized output. So it's just the reality is we cannot operate on standardized outputs. We need the data to be used and modeled for different scenarios and that data to be standardized as an input.
So I want to unpack what you just said because it's a complex point, but it's a really important point, right? So on the inputs, I think, again, the challenge historically was really just a technical challenge, right? If you think about early credit bureaus and how they digitize this stuff, like we did not, and you can look at this, right? You can look at Metro 2 format for collecting data, right? Like it's archaic by modern standards. And that's just because that's what the technology was at the time, right? It's not anyone's fault. It's just that's how sophisticated we were able to be at the time. And so when you talk about the breadth of data that can be standardized, that is just a thing that's changed technically in the last, 40 years, right? It used to be really hard to standardize a broad set of data, which is why a lot of things that make sense and can be standardized from a architectural perspective just weren't captured in credit files because it was just too much technical lift to standardize data outside of that repayment data generated by the loan servicing systems. So, like from an input perspective, I totally agree. There's a much broader set of data that should be collected, that should be able to be captured in a standardized way that can be reused, right? And going back to the point you were making before, anything we can do to make stuff more reusable so that it's not starting over from zero every time a customer walks in and asks for a loan, whether digitally or in person, that's a benefit to the whole ecosystem. It makes it more efficient, it's more convenient. So standardizing a broader range of inputs, really, really important. But then on the output front, I think again, there's a bit of a historical lens that you have to apply to this, and we'll get into this in future episodes. So I don't want to go too much on this point, but there are historical reasons why the market sort of learned maybe to trust or maybe to overly trust the idea of standardized outputs, right? Because it is really tempting to go, hey, that score is a 710, and that should just mean I can say yes, and I shouldn't have to think about it at all. But what has happened over time is lenders have learned, sometimes through painful trial and error, that there is a lot more nuance and context to underwriting, to assessment, as you're saying, right? And, a 710 to you might be very different than a 710 to me,
On
particularly
different
when I'm
products
looking
too.
at, right, different products. I'm looking at maybe different ranges of data. Maybe I have proprietary data about this customer because I have a different, broader relationship with them. Like, a 710 is not a 710 is not a 710, depending on the institution, depending on the amount of data they have on the customer, and depending on the product that they're asking for. And maybe we can pause on that point for a second, Georgina, because I know you have some really good thoughts on this. How does it differ product to product? Like, how does the product you're offering to a customer change the assessment that you want to do, or the context of how you're assessing that customer?
I mean, the simplest example would be an asset-backed loan and just a cash flow-based loan, where you have three types of attributes that matter. You have the
Yeah.
institution level risk policy.
Mm-hmm.
You have the product level policy. So are we looking at what attributes are even used in a decision around that product? Is
Mm-hmm.
cash flow a factor? Is the asset being purchased a factor? Is there's different attributes that are decision factors per product. And
Mm-hmm.
then the third piece is the profile that you're underwriting,
Mm-hmm.
and the different attributes that are pulled from the profile that are not necessarily accounted for in a standardized score. And some of that being the actual, the credit score, or, information on an application, or KYC or KYB data, or anything else that you're pulling. So there's the profile, there's the product level attributes, and then there's the institution level risk policy. And today, we're not reimagining the system. Like, this is how it operates today. It's just not,
Sure,
it's
yeah.
kind of like plastered together and not really reusable, but this is
It's just
exactly
not
how it
efficient.
operates. Yeah.
Yeah, no. So to dig into that example, and I'll just use institution level policy as the example, right? Because that's an easy one. You're right, right? I mean, the institution has a risk policy that it wants to apply across all of the loan decisions that it makes. But the problem is, to your point about, it's just not, the system's not built to accommodate this. There really is no, and I know this for a fact, actually, because I used to work for credit decisioning companies that would build a lot of the infrastructure that lenders would use for this. It's really not built on an institution level basis, right? And so there is no common infrastructure for you to say, all right, we have already evaluated these things about this borrower that match sort of the attributes we need to assess our institution level risk policy. Let's not redo that again. Let's just reuse those and carry that over here. The infrastructure to do that just doesn't exist inside these institutions. And I'd be curious for your perspective on why this is. I mean, I think one of the biggest challenges is, again, in the absence of, the credit bureaus or other sort of external parties being able to provide that infrastructure, financial institutions are just very siloed, right? Like, each product line kind of runs its own business. They buy their own decisioning systems. Like, it's really hard for a financial institution to build this common infrastructure inside of itself, just because of the nature of how each line of business runs its own business and has its own P&L, right?
Oh my God, I have so many stories. But when I first founded the company, I'm a data scientist originally. I'm not a banker. I come from cybersecurity, where data collection is very much a nonlinear process, and things are very reusable because you need to reference things at all times because everything's interconnected with each other. And in banking, it was a stark difference, to a point that I remember when we sold to our first bank. They were part of the process was like, okay, where's this data going to end up? And I said, the data lake. And they're like, what data lake? We don't have a data lake. And
Right.
and I realized that we had a bigger problem to solve, and essentially, there was no common source that I could pull from the bank, pull from or to. And so for the last 2 years, the biggest work we've done is making the customer data portable across the institution as the starting point. And so much of that is in how it's collected. Data is not collected in a way that can be shared. And I'll go as far as to say outside of Solo, that's the case. Data can live in an API. Data can live in something that a relationship manager put in manually through the core. There's no lineage to it. And so there's like a architectural reason why, and it's because if most banks today cannot even pull up customer memory and then reuse that to make a decision on a different product, which is at the core what Solo solves for, they definitely can't do that across institutions. And that's just architecturally. Then you have the economic incentives, which I know. I have a lot of opinions
I want to talk about that. I want to talk about that because, so just to put a fine point on what you said, there's an intra-institution problem, which is like inside of our institution, the different silos don't talk to each other because everyone is kind of incentivized to build their own little stack. And like when you talk to banks about a common data lake where all customer data can sit, like I can't stress enough for folks listening. If you go to like a top 10 bank and you start wading into like enterprise infrastructure for like data store, like you are entering a world of hurt with all kinds of different parties that have different political motivations. Like it gets really hairy really fast. I've been involved in those projects and they're almost impossible. They sort of die under their own weight because it's just such a hard thing to do internally. But by contrast, and again, this is where, narrowly speaking, the credit bureaus have solved this for specific areas, right? Where it's like, okay, well, let's just rely on an external service provider to create some level of standardization or data reusability for certain data attributes.
For a very narrow set.
For a very narrow set, right? So like for if I want to know, has someone repaid on, these loans, the credit card division at a bank and the mortgage division at a bank can both ask the bureau and can get sort of a standardized answer back from both, right? So in a narrow sense, in certain areas, we've solved for this. But the problem is, as we've been talking about, anything that doesn't fit in that narrow little box doesn't get captured or reused or be able to be shared across institutions. And that's the thing I want to sort of end our conversation with, which is, as much as the challenge with sort of reusing data or creating standardization is like a technology challenge, there's also a competitive element to it, right? Which is that, I, as institution A, I might not really want to make all the verified work that I've done to, understand this customer. I might not want to make that available to company B, lender B. Like there's sort of a coordination challenge across the institutions, even though, by the way, it's probably within the benefit of the entire ecosystem for more standardization to exist, which the credit bureaus as a sort of theoretical exercise have demonstrated. Like we get efficiency when we create more standardization. B, not every lender can serve every need for every customer. So it's sort of unrealistic to say like, we're going to serve 100% of this customer's needs forever, right? Like there's an expectation that consumers or business owners will work with multiple lenders over the course of their life. And then C, there is theoretically a way to sort of share economic benefits across the industry. So can you talk a little bit about when we go outside of one institution and we start talking about how do we create reusable data infrastructure across multiple institutions, what some of the logistical and economic challenges are around that?
So logistically speaking, let's just say everyone's aligned on this.
Sure.
How do we know that the way that they've done their compliance is acceptable with our standards? And the reason we even need to ask this question is because there's no traceability and no data lineage on how it got there. So even let's say everyone's on the same page and we've all decided we're going to on a cross-institutional basis be data sharing on customer data that's in a way that's customer consented. You have a problem around trusting how the information got there. And so you might think that the answer to this is just a common database where all of us put in the information in a standardized way. There's a lineage problem. How does it get there?
And to just put a point of emphasis on what you just said, people have heard me before rant and rave about credit builder products or other sort of bad data that's getting into the credit bureaus. This is an example of what you're talking about, right? Where if it's just a standard format that we're capturing the data in and anyone is given access to add data, you can very quickly, if you don't manage that carefully and worry about the lineage of the data, run into a problem where it's like, holy shit, like this trade line, I can't trust this because this is coming from someone who's not playing by the same set of rules that we are. And that creates a huge problem.
Absolutely. Even going as like simple as an address. Like you have a different address reported in Experian, and then the one that the bank shares is different. And you're trying to understand where the discrepancy happened. If you double click in and are able to see, well, they requested 2 utility bills, and that's how that data got to the core. That would be a much more verified way. That's a much more trusted way for the bank to consume the data than just saying, well, we pulled it from the core. Who pulled it? Who pulled it from the core and how did it get there?
And just to emphasize why that's important, if I can trust the lineage of the data, then I don't have to go through the manual step of going, I can't trust this. I should just have the customer submit another utility bill to me, right? So like when we say trust, what we mean is trust allows us to not redo the work that we don't want to redo again and force the customer and us to go through all that work and expense again.
Absolutely.
That's what trust is, right? Is I can rely on this other thing because I understand the lineage of it. It meets a standard that I can be comfortable with. Therefore, I don't have to ask this question of the customer for the 1,000th time.
Absolutely. The next part is the economic alignment. So we talk about data resets and how that's annoying for the customer. It's very expensive for the bank, but it's very beneficial. It's almost like a feature of the system, not a bug, to everyone that sells data into the ecosystem, because you would benefit from 4 lenders calling you on the same customer.
Or four divisions of the same lender calling you, right?
No,
I mean,
exactly.
like this is the thing about, like I'm every, like to pick on the credit bureaus, just for a second, like this is the challenge with, every division of your bank calls me 20 times to pull the same credit file. Like that's a good thing. And same thing actually applies on the data aggregator side too with open banking, right?
And
like
KYB and KYC and every other data provider benefits from a reset. And the irony of it is that they get most of their data from the compliance work that Solo's been working with the banks on for the last 2 years. And so that's why we have such a strong opinion on this, because $30 billion a year spent on back and forth, on manual data collection, on collecting utility bills from the customer. And then where does it go? It gets sent back to, not to be named, sent to the bureaus.
Sure.
And the bureaus then go and resell it back to everyone. And so this would not exist. This inefficiency would not exist if we were able to reuse the data that was collected and share it across institutions. And there's many, it's not just about the data cost, I think. It's about the fact that today banks do all this work. And if their customer goes somewhere else, whether that's a fintech or another bank, they are essentially, this data portability in its current form has made it so that they've incurred a big cost doing all this compliance work, and someone gets to access it for free.
So one of the things that you're talking about here is this idea that, and you can use open banking and data aggregators as the example of this. You can use the credit bureaus as an example of this. It's all really the same thing, right? But the idea is essentially that, you as the financial institution, you sort of have this hard decision that you have to make, right? Which is that on the one hand, you know that it is beneficial to your customer to be able to go to other places to get access to loans or other products that they might need that you can't offer, that you don't offer, right? So like there is this kind of, I always think of it as the Santa Claus from Macy's and Miracle on 34th Street. I don't know if you've ever seen that movie, but it's it's like send the parents to other stores if they have what the kid wants. That's what we should do, right? Like there's this benefit to the customer of not trying to just selfishly like hang on to the customer and never let them look outside your walls at all, right? But it's very understandable, I think, that a bank will look at that and go, all right, well, okay, that's fine. We want the customer to like look other places. We even want to be able to maybe refer the customer to other places, like send them to another store if they can get a better loan. We want to be a good fiduciary partner to the customer. But it is annoying to do all of the verification work and all of the work up front to understand the customer and to basically like lose out on all the economic benefit of all of that work you did so that the customer can go somewhere else. And I'll just put a specific example in place here because I think it's useful. The buy now, pay later companies will not furnish data to the credit bureaus, right? And I've written about this so many times in the newsletter, and it kind of is a story that's starting to drive me a little bit crazy. But the core reason is actually very understandable, which is in the year of our Lord 2025, no company is signing up to like give their data away for free to make it easier for their customers to go work with one of their competitors, right? Like that's just not an economic model in 2025 that people are going to rationally sign up for. Now, again, in the 70s and in the 80s, when like the credit bureaus were consolidating, like that was a different time. We didn't think about the value of data the way we do now. No one's signing up for this deal, which is why the BNPL providers won't furnish data. It's why open banking has become sort of a
Stripe charges if you want to port your data. Everyone thinks this is the banks wanting this. There's a couple things. There's like, I get so heated on this. The fintechs and the banks want the same things.
Yeah.
Portability in its current form does not incentivize an institution to vouch for their customers within the financial ecosystem. It vouches, it incentivizes them to hoard data like it's proprietary. And by virtue of that, they block access to other financial services. I think the way that data is spoken about today is it's not back in the day similar to bureaus where we needed a single source of truth to pull standardized data from. It's looked at from the perspective of it being the thing that replaces relationships to unlock access. So data is now synonymous with relationships and the track record that you've, as a buy now, pay later, I've invested the risk to be able to acquire this track record. And so telling you that they've repaid carries value because I took the risk. As a financial institution, I'm regulated. I have to make sure that when a deposit is put into the bank, that it's not money laundering and it's not terror financing. And so all of the burden around the staying compliant, around taking the risk, around building up this track record, we're not talking about customer data. We're talking about institutional trust. And for that to be incentivized to be shared, we're not even advocating for monetization, just so we're clear. We're advocating for a lack of redundancy and for us to be able to share across the network the institutional trust in a way that other people cannot make money off of outside of the people that created the value. And so it's less about the customer data and more about the institutional trust. And it's less about monetization and more about reducing the redundancy and making sure that the portable track record is reusable because of its lineage and because of the institutions that stand behind it across the network. And if you decide you want to monetize on the lineage of the data, not on the customer data, then you are able to enable that. And the last thing I'll say on that is if a third-party aggregator can charge for that, then most definitely the people that collected it should be able to.
Yeah, no, I mean, I think the distinction you're drawing between the data and the lineage of the data is the key idea here, right? Because, the reality is that the data itself, it's not that it doesn't have use, it's that a lot of the value for high stakes use cases requires verification and an understanding of the lineage of the data, right? Like to me, that's the difference between. Thanks for listening. This episode was brought to you by Solo. Solo resolves and connects customer data across silos, so teams stop rekeying the same customer info for the 100th time and finally move forward. Break the cycle at solo.one. That's solo.one. Sharing data in order to calculate a budget or do whatever. Like there are certain use cases of the data where it's like the data itself kind of tells us what we need to know here. But in a lot of cases, and lending is the premier example of this, right? We need to trust the lineage of the data and where it came from. Compliance is another one. We need to trust that this person has been KYC'd. It even ties into and this is a bridge too far for this conversation, but I just want to mention it. Even things like, banks in the past have explored the idea of well, can we create like a digital identity credential for consumers that they could use to go transact with other businesses? Really what they're saying is we're going through the work and the effort of KYCing this individual and verifying they are who they say they are. That should be a valuable passport that they can take other places in the ecosystem. This is all kind of tied together by this idea that it's the verification and the lineage behind it that really is where the value is. And I agree with you. I mean, I think it makes a lot of sense for banks to not hoard that work, but to be able to be incentivized to share it broadly and enable and empower the consumer. And that's almost more of like a philosophical mindset shift as much as it is like a technical architecture problem, right?
Absolutely.
Okay.
And banks and fintechs alike, anyone that's done the work of verifying and complying. I'll just end with one example here. If I were to go to a lender and tell them that they want to know how much exists in my bank account or my income, and I show them $300,000 in cash, that's not an asset. That's a liability. To them, that's a liability because they need to know where it came from. They need to know it's not money laundering. Otherwise, they are in trouble.
Right. Okay, well, I think that is a perfect place to leave the discussion. We could go on and on about this, and we will over the course of the rest of this series, which I'm looking forward to digging into more aspects of this. But this was a great way to tee off the series. Georgina, thank you, as always. I enjoy our conversations. I'm glad we got to record this one.
Me too. Thank you, Alex.